Well, thank you so much for that excellent introduction. I am thrilled to be here with you. I hope you're thrilled. Who's ready for an hour of economic data and charts at 9 a.m., huh? Woo! Yeah, let's go. Let's go. That's right. Back in college. That's right. What you will find is that my economic presentation is unlike others because I tend to focus on the things that actually make a difference in your business. I am an applied economist rather than a theoretical one. And so we'll talk about all of the data, but most importantly, I'm going to connect that data to action, to things that you should do in your businesses to have the kind of outcome that you want to have both this year, next year, and beyond. Okay? We've got a lot to cover, but the main theme that I want to plant in your minds at the beginning here is that if at the beginning of the year, the key word that we were all dealing with was uncertainty, what we're clearly starting to see and understand is that we are now transitioning to a period of complexity. It is the knowledge that we are not going to have clarity in terms of exactly what's going to happen. The environment will continue to evolve and be highly complex from a policy perspective in terms of geopolitics and the economic data, especially in a lack of a reporting environment like we're in right now because of the government shutdown. But that does not mean that you have to have this deer in the headlights perspective, right? You don't have to wait and see anymore. Your people, specifically the ones that look to you for leadership and decision-making, you can project an aura of confidence without knowing exactly what's going to happen in the future because you've done this before. As recently as just a few years ago, when you had to adapt your businesses to COVID, you had to create a whole new way of doing business. And so you have calluses on your hands in terms of the decision-making. And what you need to project is an aura of confidence that we will figure this out no matter what's going on, right? No matter how much volatility there is, no matter how much uncertainty persists, we can do this together. I don't have the exact answers, but I do have faith in our ability to get it done. And that's the mindset that I want you to bring to planning for 2026 and beyond. So another term that I think that we can call the presentation instead of the official economic and policy update is, this is fine. Right? Like this is basically where we're operating today. We're this little dog having a cup of coffee, the world's on fire around us, and we're gonna get along and figure out how to proceed from here. So I've got a lot to cover with you over the next 45 minutes or so. Bear with me, it's gonna feel a bit like a fire hose of information, but I promise I will make a narrative that you can easily follow along and see the things that you need to be doing in response to the economic data that I'll be sharing with you. So I'll cover the impact of tariffs and the One Big Beautiful Bill Act. I'll talk big picture at first about kind of the globe at large and the driving forces for what I think is causing President Trump and his administration to behave and to seek the agenda that they're pursuing right now. I'll share the latest economic data and, as always, actionable takeaways peppered throughout. And certainly at the end, I'll wrap it all up in a nice little package for you. So let's start by zooming out, okay? Imagine this is the satellite view of the global economy. And I like to start here because I find that there are notions that get propagated in the news, whether it's online, through the media, or in chat channels like Reddit and so on, that are just untrue. And these messages are driven by fear, because fear draws your eyeballs. You're much more likely to click on an article that says the world is going to end tomorrow, click here to read more about why, than everything is fine, go on about your day, right? So like that logic permeates everything that we do right now. But there are some false narratives that I want to dispel right away. The first narrative that I think is categorically false is that the United States is somehow losing, that we are somehow being overtaken by our competitors and our adversaries in terms of our economic clout and status. It is categorically untrue. This data, both the left and the right, comes from a source that if you like data, you should be aware of. It's called Visual Capitalist. It's freely available. I don't have anything to do with that company, but I do find it very compelling in the way that they translate complex data sources into easy to follow visuals. So a snapshot of the global economy is on the left, and the way that that economy has evolved is on the right. So a few key points of commentary here. First, notice that the US, let me go back just a second. The US, this blue area here, is still by far the world's largest economy. We are $30 trillion strong this year, as of 2025, out of a total global GDP of 115 trillion. So we are more than a quarter of the global economy by ourselves. The second largest, China, which you can see at the top of the chart there, is still, after multiple decades of double-digit growth, below $20 trillion. So as we sit here today, the US economy is 1/3 larger than China. And because their growth rates have slowed dramatically as well as ours have, they are not likely to overtake us for the top position at the peak of the pyramid anytime soon. And in my opinion, never, because of some of the major structural challenges that they face in terms of demographic shifts, population decline, kind of the way that they run their country. So we are not imminently, or in my view, ever going to be overtaken as the largest economy in the world, at least not in the foreseeable future, okay? Whoop, a little bit of feedback there. Sorry about that. I'm not sure what's going on with the audio. This thing like turned on all of a sudden. I know I'm passionate, but come on, calm down a little bit. All right. The other point that I want to make for you here is that the news cycle tends to pick up on actors around the world that are really good at rattling their sabers, being disruptors, but they're not actually that important from an economic perspective. So a few examples of these would include North Korea, Iran, and yes, even Russia. If you take a look here in this top corner of the teal area, you can see that the Russian economy in 2015 is a total of $2.2 trillion. That is less than a tenth the size of the US economy. In fact, the economy of the New York City metropolitan area, including some burbs and New Jersey, is bigger by itself than the entire Russian economy. I like to bring up that fact. Well, let me back up. I'm originally from Ukraine, and so I have some skin in the game when I talk about this, right? But I like to think of Russia as a gas station that also sells guns. Like, that's basically what Russia is in a nutshell, right? Like, if you break it down. I mean, obviously, I say that to make myself feel better. In reality, they're not even a very good gas station anymore because the Ukrainians are so good at pummeling their energy infrastructure. They've taken up like 40% of their refining capacity offline in the last few months. And so there's massive gas shortages in Russia. So they're basically a guy in a trench coat walking around with guns on both sides. That's the way I like to think of Russia. On the right-hand side, what you see here is the way that the global economy has evolved over the last 50 years. So starting in 1980 on the left, going all the way through 2024 on the right. Notice that the United States, which is the white line at the top, was 26% of the global economy in 1980. And look forward to the far right-hand side, it is 26% of the global economy today. We have not lost any market share as the global economy has grown. Now, that cannot be said for some of our closest partners and allies. The blue line below the white one, that's Europe. They used to have almost 30% of the global economic activity. Now it's as low as 17%. If we look at the pink line there, that's Japan. Japan peaked in the mid 1990s in the heyday of Nintendo and Sony and Philips and all of these big Japanese powerhouse companies. And today, the Japanese economy is less than 4% of global GDP. So I think one of the things that is going on in the world today is President Trump and his cabinet, especially Secretary Bessent of the Treasury, Secretary Lutnick of the Commerce Department, they're looking at this picture and they're thinking to themselves, how do we ensure that we do not follow the fate of our partners and allies, meaning this decline in clout and economic presence? Because what they're also seeing is the red line, which is China. When we invited and supported China's ascension to the World Trade Organization in early 2000, you can very clearly see the effect that that had on their market share. They're nearly 17% of the global economy today. So they're observing this and they're saying, how can we ensure that we throttle some of that market share gains that they've been achieving? How do we ensure that they don't overtake the United States to be that largest economy in the world? And some of the policy initiatives, whether you agree with President Trump or disagree with him, that's totally up to you. But in an objective analysis, I can see, yes, let's throw some roadblocks in front of China. Let's make sure we stifle their trade. Let's make sure we make it more expensive for them to dump products into the US market. That's one of the things that I believe is going on right now, okay? I'm also very encouraged by the fact, if you look at the white line once again, off of that low point that we hit in 2008, 2009 during the Great Recession, we've actually achieved market share growth over the last 15 years. But if you look at the Chinese line, that red line peaked in 2000, and because of the draconian closures during COVID and the lack of a rebound in the Chinese economy since then, we have seen the share slightly decline. So these are trends that are favorable to what President Trump and his cabinet are trying to achieve, and I think they're going to continue to pursue that. So number one, we are the largest economy in the world. Number two, the administration is trying to keep it that way. However, this is not the only way to think about things. And in an effort to be objective and apolitical, I always like to look at things from multiple perspectives. So when you think about economic footprint, GDP is one way to measure that, but there's also another way that I think is just as important, and that has to do with purchasing power parity. What is PPP? In a nutshell, it basically talks about the affordability of certain goods and services within each country. So some of you may be familiar with the Big Mac Index, for example. That measures the cost of a Big Mac sandwich from McDonald's in a lot of different countries all around the world. And I can tell you definitively that a Big Mac costs a lot more in the US and in Europe than it does in Cambodia or in Argentina, right? The prices are very different. So where this really comes into play, where the rubber really hits the road here, is the military and defense space. So first, you see that in terms of purchasing power parity, China is actually the largest economy. The affordability factor favors them so significantly that they are larger in terms of PPP than the US. That means that even though they don't have as much money circulating in the system or are not responsible for as much overall economic activity, the affordability of things inside the country means that there's actually a lot more going on that first meets the eye. On the right-hand side, you can see this is military spending and for all of 2024. So at face value, the US is by far the juggernaut, right? We spent almost $1 trillion on our defense last year. In comparison, China only spent $314 billion, Russia only $150 billion. But when you factor in the concept of purchasing power parity, and when you recognize the fact that for the same amount of money, the Chinese can afford to buy a lot more missiles and drones and ships and tanks and planes and soldiers, then the playing field is a lot more level. And in terms of actual buying power, they're spending close to $800 to $900 billion, which helps explain why the gap in military power projection has been closing so quickly over the last couple of decades. Even though the overall amount of money they're spending is not as high, this ability to afford more things makes a huge difference. The other element that we've got to keep in mind here is that the scale of production that they've been able to achieve is really remarkable. So on average, a US production volume for ships, especially military vessels, in a given year is somewhere between 5 and 10 in all of the different shipyards that we have here. On average, the Chinese can produce somewhere between 300 and 400 ships. It's a factor of 200x higher. And also, the commercial grade vessels like transport ships and cargo ferries and so on are built in China to military grade spec. That means instead of cars and people, they can transport tanks and soldiers. They can carry that heavier weight. And so the other thing that I think is going on here is the administration is watching this very carefully, and they're saying, unless we start to do something about this, they are eventually going to catch up and expand their power projection beyond the Indo-Pacific region, beyond the South China Sea, and are actually going to be challenging us in other theaters all around the world. This is something that we're also trying to stop, because President Trump has been very clear about this. And as much as it hurts me to admit this, I agree with him. Russia is not our primary adversary. We love to paint the Russians as the bad guys, especially in the movies, but it is the Chinese that we should be worried about the most, because they pose the most existential threat to our superiority, both economically and militarily. So I hope that gives you a little bit of context about what's going on and why the administration is pursuing some of the policy actions that we've seen from them so far this year. So the way that they're going about this, by and large, is through trade and tariffs, right? And increasingly, what we see is that they're not doing it the same way that President Trump approached this during his first term in office from 2017 to 2020. Back then, he was trying to get congressional and also the backing of his own party, of the GOP and of the Republican Party, to support the various tariffs, whether it was Section 301 or Section 232. They were very product-oriented, specific categories that we felt the Chinese were dumping into the US market. But this time around, he's acting unilaterally, meaning he's not waiting for anyone's permission, he's not getting the backing of Congress, and certainly not even of his own party. He is just writing executive order after executive order. The negotiating points that we're pursuing as these geopolitical levers are also quite different this time around. So yes, trade deficit is still something that we talk a lot about, but the trade deficit issue is a murky one. It's not very straightforward. For example, we have a huge trade deficit with China because they export a lot more things that we provide to them. We also have a trade deficit with Canada, but it's of a very different nature. If you look at our exports to Canada, outside of our purchases of Canadian oil, we are actually a net exporter. We send more things into Canada outside of oil and gas than they send into here. And the reason why we don't want to address the trade deficit with Canada is because when we buy their heavy sour crude through the massive network of pipelines that we've built up, we are getting that at a substantial discount. Our refineries are then taking that oil, turning it into diesel and gasoline and jet fuel, and we are selling that to the broader world at a much higher profit margin. So we don't want to cut back on that trade deficit. We want more cheap Canadian oil to feed our refinery processes. So when we talk to the Chinese, we're talking to them about the trade deficit, but also issues like national security and critical minerals, because there are specific materials that China dominates. I'll give you a perfect example. There's an element called gallium. It's used in everything from satellites to telecommunication equipment to semiconductor production, and yes, in the military and defense space as well. And gallium is 98% produced and refined in China. And so if they remove this from the table, if we're no longer able to access this element, it's going to hamper significantly our goals, both economically and militarily. When we talk to the Canadians and the Mexicans, we're also talking about immigration and the drug trade and this very important issue specifically to your industry of Chinese transshipments, when they're sending stuff to Canada and Mexico and then trucking it across the border to circumvent the existing tariff regime and sanctions that exist there. When we're talking to some of our other trading partners, the Europeans, the Brazilians, the Indians, we talk about NATO defense spending and internal politics, like this issue with the Brazil persecution of the previous president, Bolsonaro, right? President Trump, this is a clear indication to me of something that is more of a personal grievance rather than an actual national security issue. He saw the legal pursuit of jail time on the behalf of the Brazilian government against Bolsonaro because he tried to stage a coup very similar to what happened on January 6th here, but he is now in prison for it. And so President Trump said, well, they're pursuing this witch hunt, I really don't like it, and overnight changed the tariff on Brazil without any previous warning from 25% to 50%. Making it almost impossible for companies that do business with Brazil to function in a normal, predictable environment. A similar issue happened with India, but that was less of a personal thing. We're trying to convince India to buy less Russian oil and gas. They're one of the largest purchasers of the discounted stuff they get from the Russians. By the way, they're probably paying about 50% of market rate because nobody else wants to buy Russian fuel outside of countries like India, China, and perhaps a few others. But there too, once again, without any previous warning, they just overnight, President Trump decided to double the tariff on India from 25 to 50%. And that has real ramifications. In fact, those ramifications, these X factors that you see in the bottom, is why I'm very cautious about this strategy. I think it's fraught with unintended consequences and a lot of geopolitical risk for us. In the case of the Chinese, this issue of rare earths, these are materials that go into making magnets, wind turbines, electric motors. They control, once again, over 97% of production of these materials, and they have been showing us that they're very much willing to choke off supply to the United States. Not only direct sales to the US, but even influencing some of our trading partners to say, if you buy these things from us, you have to promise you will not sell them to the United States. Okay? They also have the ability to influence other bad actors like Russia, Iran, and North Korea. In the case of our more traditional trading partners, we have to recognize one very simple fact. We all pay attention to the political process here in the United States, and we all know that we went through a big presidential election cycle last year. Now, that brought in a lot of change for the US, politically, economically, and so on. What most people don't realize is that over half of the globe went through a major election cycle last year, and in almost every single instance, the electorate chose to move firmly to the right. Conservative, inward focused, not globalization-oriented, but rather self-serving in their interests. And these are not the same people that we were negotiating with back in President Trump's first term. They're much less likely to play nice in those negotiations. So that's a vulnerability, I think, as part of this process. But the biggest one for me is pushing our traditional friends and allies into the very open and waiting arms of our adversaries, of Russia and China. This closer China ties, long-term, strategically, is one of the biggest potential threats to this plan. And we saw this play out just recently. 2 weeks ago, President Modi from India was in Beijing for a summit where he looked very, very chum-chum with Putin and Xi. This is not something that we want to see consistently happen. We don't want to push the Canadians or the Mexicans to do more business with China. We really want to be very careful here. So in some cases, I can get behind this policy. I can say, yes, let's pursue tougher negotiating position with the Chinese. In other cases, like Canada, for instance, I say, it doesn't make any sense to me what we're trying to accomplish. And the fact that we have a 35% tariff on Canada, but a 25% tariff on Mexico, where's the sense in that? So if I were to get President Trump's ear, I would let him hear all of these things. Unfortunately, he's a busy man. He doesn't have time for that. But these are the things that we all have to be thinking about as American citizens that will drive our opinion and the way that we vote in the future as well. So I don't want to go into too much detail on the tariff thing, other than to say there are 3 basic tariff categories. The first one is called IEEPA. That's the International Emergency Economic Powers Act. Basically, President Trump says, we have an economic emergency, and in response, I have to put in these tariffs. That's been basically the dominant source of all of these reciprocal tariffs that were announced on April 2nd, Liberation Day. Then we have the Section 232 national security-oriented tariffs. President Trump says, this is a threat to our national security. Therefore, we're going to do a study. This study comes back many months later, and we issue a product category-specific tariffs. And you can see right now it's everything from steel and aluminum, which obviously affects your industry a great deal, to cars and car parts. And there are currently 12 active investigations into future product categories that will be covered by Section 232 tariffs sometime between now and probably the middle of next year. So this environment, the volatility, isn't going anywhere, right? You have to be transitioning to this thought of it's going to be complex moving forward. And what I want you to start thinking increasingly about is wargaming this situation. There was a really neat term that I just recently learned. It's called VUCA, V-U-C-A. It's a term that comes from West Point Military Academy, and it stands for volatility, uncertainty, complexity, and ambiguity. This is the new world that we live in, and it's not changing. It is not going to get easier. So in order to react to this, what can you do? You can scenario plan. You have to project what is the possibility of these things happening, and then come up with action plans that you can implement proactively rather than being reactive in a variety of scenarios. You also can't have this wait-and-see mentality forever, because the more we do that, the more there's built-up, pent-up demand, the more that when things actually improve, it's going to be another supply chain crisis. We're all going to be rushing for the exits, or the entrances, I should say, at the same time. So don't wait. If you have the justification to pull a trigger on a project, maybe it's not as good of an ROI project as you want, but it makes sense to move something forward, or you've been delaying that CapEx expenditure, do it, okay? It's not going to get any easier to be able to predict the future. Really interesting development a few weeks ago, an appellate court ruled that the IEEPA tariffs are actually unconstitutional. And on November 5th, there's going to be a Supreme Court hearing where the Supreme Court justices are going to take up this issue and basically answer the question, how much authority does President Trump have to unilaterally bypass Congress and pass these tariffs? I can tell you the administration is not convinced they're going to win that battle. Already, they're making contingency plans to go much more into that Section 232 area rather than doing this as Emergency Economic Powers Act type of behavior. So I'll close out my concept of tariffs here with a kind of a silver lining to the cloud. I know it's been a hugely challenging environment for all of you. Prices are up, complexity is up, but the fears that we all had in the beginning of the year, that this was going to be super disruptive to the economy and might actually send us into recession, have not come to fruition. Why? Because there's an actual difference between what the effective tariff rate and what we're collecting at customs, okay? So if you look at this chart, at the bottom left-hand corner, you can see that at the beginning of the year, before President Trump took office, the actual tariff, or the effective tariff rate was 2%. Through the various iterations, and you can see all the text talking about all the different developments, we are currently at about an 18% effective tariff rate. That means that if you take all the different product categories, apply all of the different math and the percentages, you get an average of around 18%. But we have not been paying 18%. There's been an actual tariff rate somewhere closer to the 9% mark. And that's because companies are using different techniques to mitigate the worst impact of these tariffs. And you can see this pie chart. This came from Goldman Sachs. They're showing you where are we actually negotiating. So 9% of the tariffs have actually been mitigated by asking the foreign companies, the exporters into the US market, to lower their prices. What President Trump has been talking about all along, which is if they want to maintain market share, they'll lower their rates to be competitive. But that's only 9% of the pie. 51% of the pie, so the majority at this point, is absorbed by US companies. It is a US business that pays the tariff as a tax when they accept the import of goods at the border. That a US company pays those to Customs and Border Protection. So when President Trump says other countries are paying these tariffs, that is not true. It is American companies, and you can see to some extent the American consumer. 37% of the tariff increase has been passed on to you and I as individual consumers. So you've got to understand what's happening here is it's basically a consumption tax that is currently being largely shared between companies and the US consuming public. So what are the implications of that? Well, the implications are that we are still in the very early innings of how this is going to affect pricing. Okay? On average, tariffs take somewhere between 12 and 18 months to fully filter through the system and be felt in terms of inflation. So what I'm showing you here, this is the Consumer Price Index, the most broad-based measure of inflation that exists. The light blue line is the overall CPI. The dark blue line is the core CPI. That's when we factor out very volatile food and energy prices. And what you can see on the far right-hand side is we're not getting closer to the Fed's 2% target. We're getting further away from it. And I expect that trend to continue as we go through the rest of this year and into 2026. In fact, as you can see, my likely range on the CPI by year-end 2025 is between 3 and 5%. We are, despite the government shutdown, we're going to get a new CPI number. I think it's coming at the end of the week on Friday. So pay attention to that. I imagine we're going to go from 3% slightly higher. Not significantly higher, but it's going to be this gradual, slow burn effect of the price being filtered through on the inflationary side. And with all the tariffs still lined up in terms of those future 232 actions, there could be potentially higher room on the upside. We could go 4, 5, 6% on inflation. I don't think we're going to end up at the peak where we were in 2022, right? 9% or 7% on the core. But it's very possible in my mind that we're in that 4, 5, 6% inflation, which means that all of this hope that the industry has for lower interest rates as a kind of stimulant to future construction activity, we have to be cautious about that. It's okay to be cautiously optimistic, but I wouldn't expect this to open up the floodgates of construction activity because the Fed, as I'll show you later, is only signaling that they're trying to get away from restrictive interest rate policy that stifles economic growth and activity to one that is neutral. They're not looking to go accommodative, which is where you have low borrowing costs that really stimulate a lot of new buying and construction activity. So temper your expectations there. But the key element here that I want you to walk away with from a business perspective is very simple. You are not in business to grow revenue. you are in business to make a profit. And this means that you are likely to see the cost of doing business continue to rise. Your people are going to be more expensive. Your materials are going to be more expensive. And this is happening at a time when the public in general is growing increasingly pessimistic about the prospects for the US economy. And so they will push back on potential price increases that you're going to be looking to pass on in order to maintain your profits. So as you think about 2026, if you walk away with nothing else from my talk, let it be this: maintain profitability. It is the profit margin that is the key to your future success. It is not top-line growth through price increases. It is making sure you've got money to reinvest back into the business. That's the key element in play here. I also want to talk about some positives, right? It's not all negative. And again, I always try to be objective. Let's look at both sides of the coin. The One Big Beautiful Bill Act in the near term is very much going to be a positive stimulant for the economy. Now, it is a highly complex piece of legislation, one of the most complex pieces of legislation that I've ever seen. In fact, there are 82 mentions that say the US Commerce Secretary will do this, ... Like they haven't even finalized all the rules yet. So my recommendation to you here is twofold. Number one, recognize that the lowest hanging fruit that you can take advantage of as business leaders is accelerated depreciation, meaning any CapEx that you do for the business is 100% written off this year. That was not the case last year. And domestic R&D expenditures. If you're developing new products, new services, you can write off all of the development costs against your taxes. This is how you offset some of those rising costs related to tariffs. This is the low-hanging fruit. But if you really want to understand the implications of this significant piece of policy to your business, you've got to look for external experts, subject matter experts in tax policy that can tell you, look at Section 179 limits, for example, and other things that are very potentially advantageous for your businesses, but the general public, including typical business owners, they just don't have the understanding of this law to bring it to bear fully. So consult outside experts where you don't have the expertise yourself. It's not a shame to do that. In this complex environment, you almost have to. You can't know everything that's going on, okay? All right, so that's the policy piece. I know that's a lot to process. I hope I was able to weave a compelling narrative for you. Now let's look at the economic data here. And this is really important because I want to dispel the notion that the US is either headed towards a recession or the ridiculous concept that we're in one right now. So this is US real GDP. Real GDP means we've already factored out the impact of price increases. This is outside of inflation. And what you can see when you plot the quarterly data is we're at a record high through mid-2025. So I don't know where the people talking about recession get their information. The economy has never been more robust or bigger than it is today. If you have family, friends, or colleagues that are constantly doom and gloom, I'll make this deck available. Share this with them and say, where is the recession that you're talking about? I don't understand, okay? So this is one way of looking at economic data. Think of this as a person, okay? Think of the economy as an individual. When you meet a person for the first time, you can tell some things about their state of affairs by looking on the outside. Is their skin tone looking healthy? Are they disheveled? Are they sweating profusely? But to get a real sense of their health, you've got to look below the surface. Vital signs, right? Cholesterol level, blood pressure, heart rate. This is the face value of the economy. This data is the exact same data, but plotted as a growth rate. This is what is called the business cycle of the economy, and these are the vital signs. So the light blue line here is the quarter-over-quarter growth rate plotted over time, going all the way back to 2004. Why do I say quarter-over-quarter? Because that is the way that you run your business. You don't look at Q2 compared to Q1. You look at Q2 compared to Q2 from last year. That's the year-over-year comparison that you're making. And yet, that is not how the government, for some reason, publishes GDP data. They're always sequential. So when you read this figure that Q1 GDP was negative, that's comparing Q1 to Q4. Q4 was the holiday season. Q1, kind of a lull and uncertainty, right? Of course it's going to be sequentially negative. There are other elements involved, like inventory build-out and a pulling forward of orders to anticipate tariffs, but it doesn't make sense. So you will never see these figures in the public domain. The news sources don't look at it this way, but you should be. So this 2.1% that you can see on the far right says Q2 of this year was 2.1% above Q2 of 2024. We are not in a recession, ladies and gentlemen. We're not even heading for one, because if you look at where that is, it's in line with the historic average of 2% growth that we've seen for the last 20 years. So those people that are doom and gloom out there always say, okay, show me the proof, right? Where is the data that supports what you're saying? And they oftentimes cannot. So we're not in a recession. We're not imminently heading for one. Now, understand that the overall economy, what I just showed you, GDP, is comprised of three key elements. It's personal consumption. That's the money you and I spend living our daily lives, buying furniture, clothing, going to restaurants, seeing concerts, and so on. That is 2/3 of overall GDP. But that is not reflective of your business. Your business is the slice of the economy that is the industrial economy, B2B, CapEx driven, right? It is very different driving forces behind it. And so when you look at industrial production, this should be the benchmark to which you compare your own company performance to, not GDP. And industrial production, unfortunately, has not been behaving in the same way as what we saw for GDP. In fact, if you look at the far right, what you'll see is that we've basically had minimal growth in the industrial economy for the better part of 3 years now. We're up just 0.4% since fall of 2023. Okay? And the reason, a big reason behind that has been this restrictive interest rate environment. Companies do not like to borrow money at these high rates. Project ROIs don't justify it, and so we've been waiting for the Fed to lower those rates. Okay? If you look at this data once again on a business cycle basis, you can start to ascertain really key inputs about what the future holds as well. So this is the business cycle for the industrial economy. The light blue line here is quarterly growth. The dark blue line is annual growth, okay? You can see anytime those lines are below the dotted line in the middle, that's an industrial recession. We really haven't had that, but you can also see that from 23 through early 2025, those lines were basically skirting zero. There was no growth to be had for a couple of years. And then look to the far right. Look at that light blue line starting in November of 2024. I wonder what happened at that point. It started to rise and rise quite dramatically. When President Trump was first elected, businesses were very optimistic. They were expecting momentum. They were starting to open up spending. They wanted deregulation, more favorable tax climate, favorable business policy. President Trump, after all, is a businessman himself. Surely he will help us out. And so we saw, for the first time in a couple of years, the momentum start to really tick up and to the right. And you can see that very clearly in that light blue line. But then that peak that you can observe near the far right-hand side happened in coincidence with April 2nd. That momentum through Liberation Day was broken, and we are now trending sideways. Those lines are converging, and yes, it's still in positive territory, but 0.7% year-over-year growth is nothing to celebrate, right? So the key element that I want you to understand here is the light blue line actually predicts what the dark blue line is going to do 2 quarters in advance. So the fact that they are now converging says that into early 2026, the most probable pathway for the US economy is flat compared to where we are right now. It is not up. It's certainly not down, but it's also nothing to celebrate there. So it's the first piece of evidence that we have that says we are likely to be treading water until there is some kind of calming or stability in the policy environment. Let's look at other elements that are going on there besides this. So what I showed you so far is hard data. There's also something called sentiment or soft data. This is measuring the way that we talk, think, and feel about the economy. And a good example of this is the Conference Board's Small Business Optimism Index, which measures CEO confidence. So you'll observe some very similar trends here. That light blue line on the far right was rising off of a low in 2022. It rose until April, at which point it fell completely off a cliff. And if you look at the May data from that perspective, pessimism in the CEO community was equal to what we saw during Q2 of 2020. We thought the prospects for the economy after Liberation Day was as bad as when we had completely shut the economy down in response to COVID. It just goes to show you that this data can be quite fickle. We are very reactive and emotional in our response. Since that point, we've had a nice rebound, but notice it's only rebounded to that yellow dotted line, which measures basically no growth and no contraction. This is another piece of evidence that says our likeliest path forward is sideways. And the final one that I want to show you here is actually something that I'm going to teach you to do for your own business. So I've been informing so far, kind of doing not a data dump, but basically sharing information. This is something that you can actually apply to your business. So pay attention for the next couple of minutes. Leading indicators are economic series that can predict with a high degree of confidence and a lot of certainty what a different data series is going to do. In this example, you've got two lines. Light blue is a leading or predictive indicator. Dark blue is a subset of industry data. So imagine this is your annual growth rate for your business. The dark blue line says currently you're up about 6% year over year. So what are we looking for here? We're looking at the relationship in terms of timing when the turns happen. So this turn happened in 4Q of 09. It was followed by the turn in the dark blue line a year later in 4Q of 2010, which suggests that there's a 12-month lead time between the light blue and the dark blue line. And you can see consistently that the turns in the light blue at the lows and the highs always happen about a year before the turn in the dark blue line happens. Once we establish that relationship, we can actually look at the last 12 months of data in the light blue line. And keep in mind, this is not a guess. It's not a forecast. This has already taken place. It's historic information. And we can physically manipulate it by pushing it forward by 12 months and leveraging the input from that insight to predict what the dark blue line is going to do. So even though we're up 6% right now, a year from now, the likeliest trajectory of the dark blue line and its performance is to be flat, zero growth. So think about the implications here. Let me back up for a step. In terms of business decision making. If you're at 6% growth and you've enjoyed a very nice multi-year accelerating trend, what do you want to do as a business leader? You want to invest, buy more equipment, increase inventory, hire more people. But if you know that a year from now you're not going to be growing 6%, you're going to be at zero and potentially heading further south, the actual course of action is the exact opposite of that. You want to be conservative, you want to tighten the belt, don't want to commit to any long-term expenses there, right? So using leading indicators, you can see around the corner, half a business cycle ahead for either the macroeconomy, a specific industry like construction, or individual company performance. I help individual companies identify and track their own leading indicators all the time, okay? So let's take this methodology that I've just shared with you and apply it to the industrial economy that is the benchmark for your industry to see what are the prospects for us as we go into 2026. The first one I'm showing you here, in each case, in these next few slides, light blue is always the leading indicator, dark blue is industrial production. So this is industry capacity utilization rate. Why am I using this? Because it actually measures what percentage of our total production capacity are we using today to meet today's level of demand. It's got a 6-month lead to industrial production, and you can see it's flat 6 months into the future, skirting that zero line, meaning not up, not down. You always want to build a body of evidence. You don't want to rely on a single leading indicator. And so another one that I really like is copper futures prices. Why copper? Because it has a PhD in economics. It's known as Dr. Copper. It's so prevalent in how frequently it's used in all sorts of industries. Obviously construction, industrial manufacturing, automotive, electronics. So the entire economy uses copper at a large scale. It's got a 9-month lead time. And look, once again, the signal is volatility, but movement to the sideways, not up or down. So this is saying into mid-2026, we can expect the industrial production index to basically be kind of flat in its profile. And then the last one, and my favorite of all of these, is the PMI, or the Purchasing Managers Index. This leads the industrial economy by a full year. And it just makes so much logical sense to me. This is literally asking people responsible for future buying behavior, what are your plans over the next 12 months? Are you going to buy more? Are you going to buy less? Are you going to buy about the same? And this too, it's trying to break out, but every time, in fact, the last drop-off you can see there coincided with, once again, April Liberation Day tariff announcement. It's moving to the side. So when I look at the entirety of the evidence that I've shared with you so far today, it is very clear to me that we're not imminently heading for a recession, but unless we can get out of our own way, and until that actually happens, the economy is likely to tread water, which is where we've been over the last few months so far. So low single-digit growth, that means that if you're planning revenue growth of 5, 6, 7, or higher percentage next year, it can only come from two places: increasing your price or taking market share. The economy is not going to be giving you that level of growth as we look out towards 2026. All right, last couple of minutes, and I do want to make sure I leave time for Q&A on the back end. The labor market. I want to finish with this because this has been kind of looked at as the boogeyman that heralds the coming recession. I just don't agree with this perspective. Yes, additions of new job, like hiring, has slowed dramatically for a variety of reasons, right? We have this immigration push that we're doing. We have companies in wait-and-see mode. And so in August, we only added 22,000 jobs to the economy. The unemployment rate did tick up from 4.2 to 4.3%, still relatively low by historic standards, certainly not one that screams recession. The last number I think is very important for you to know about, because average hourly earnings for the last 12 months overall in the United States are up 3.7%. That means as you go to plan cost of living adjustments for your employees, the COLA stuff, the annual adjustment, you've got to be in that range just to be competitive. And also, by the way, inflation is at 3%. So if you're below 3%, your people are going to feel like they're losing ground. They're being left behind. So that's the kind of cost basis that you've got to budget into your HR payroll for next year. 3 to 4% growth on top of what you're paying in 2025. Individually, let's look at those figures. So August data was low at 22,000. Notice the 6 months before April. Again, the data is pretty consistent. It doesn't have opinions. It doesn't lie. It just shows you the world as it really is. The 6 months heading into April, we added over 100,000 jobs consistently to the US economy. Then after Liberation Day, look at what happened. It drops off a cliff. In fact, if you look at the June number, after the revisions, it showed that for the first time in almost 5 years, we lost jobs in the US economy in June. Now, there was a nice bounce back in July, but you can see August was weak once again. We are, again, despite the government shutdown, getting a new jobs number. I think it's happening around the 25th of the month, so it's been delayed substantially, but pay attention to that. That's going to be a big read in terms of the momentum in the labor market. But for me, it's not about how many jobs we add. The question is more about, are all of the people that want to have jobs in this country remaining gainfully employed? And by and large, the answer to that question is very much yes. This is layoffs data, and you can see every time we're heading into a recession, the layoffs start to spike. So here, 2008, 2009, we've had layoff surge of 12 million. What happened in 2020 in response to COVID was so remarkable, so unprecedented. This line, I couldn't fit it all on the chart. If I were to plot it all for you, it would be 5 times higher than what you're seeing right now. That's how uncharacteristic that period of time was. But then we rebounded very quickly. By Q3, Q4, we were hiring all those people back. And the companies that had the wherewithal to keep their employees, maybe have them work less hours, go part-time, but they didn't fire them, those are the ones that came out of the gate strong and took a bunch of market share starting in 2021 and 2022. So when we look at the latest data here, we're basically operating at 2019 levels of layoffs right now. Nothing scary, nothing that points to a significant decline in personal consumption expenditure, which I mentioned to you earlier, drives 70% of GDP. So I just don't see that happening here. One other really important caveat, especially if you are looking to hire people, don't use the national unemployment rate as an input, right? If you look at management, so if you're looking to hire a good, experienced people manager, the unemployment rate for those folks right now is 1.8%. For engineers, it's 1.4%. So the decisions that you're making have to be relevant at the position level, not just looking at the overall labor market. And here's one thing that I really want to stress for you. You want to retain the folks that you have, especially the difference makers. You cannot afford to lose them, because when the economy does, when we get out of our own way and we can have that next leg upward, you're going to want those people around. It's going to be another mad scramble for talent, and it's a lot less talent available given the dynamics of the immigration stuff that's going on in the country right now. One last comment, and then I promise I'm going to wrap it up. This is the famous dot plot chart, okay? This is each member of the FOMC, or the Federal Open Market Committee that sets interest rate policy. This is where they think the federal funds rate will end each one of these years. This is all publicly available information. You can see they're projecting 2 more 25 basis point or 0.25% cuts to the interest rate environment before the end of the year, and then probably 1 more in early 2026. But I caution you to not look at falling interest rates and expect a great deal of business activity to manifest as a result of that. Because where we are today in this range of 4 to 4.25 is called restrictive interest rate policy. This is the Fed actually throttling down the economy because they're trying to keep a lid down on inflation. When we get to that 3.5% mark, then we're in neutral territory. That means it doesn't help the economy and it doesn't hurt the economy. In order for us to be accommodative, meaning like actually stimulate growth, we've got to be at 2.5% or below, and there's nothing on this chart that indicates we're heading there anytime soon. So again, expectations of lower interest rates in the future being a huge driver of your business need to be tempered as a result. All right, that's it. You got through the content. Let me kind of boil it down into a nice package for you to take home. From a strategic perspective, you've got to make sure that you're driven by data rather than emotions. You've got to continue to maintain acute attention to the supply chain, so HTS codes, tariff impact. But the most important thing I want you to do is simulate and prepare action plans for a variety of scenarios. Adopt the VUCA mindset of West Point and war game this thing. That doesn't mean that you have to take full responsibility of it. Bring in experts, as I mentioned earlier, when you need to, but somebody has to own this process and somebody has to be communicating all of this up to the management team. In terms of the actions, the specific tactical things you can do all center around a very basic question. What can you control in this environment? And despite the volatility, despite the uncertainty, despite the very nice sound effects I'm getting in the back here, we are able to control some things. For example, the amount of communication that you have up and down the supply chain. If you're currently talking to your main suppliers once a quarter, make that monthly. If you're talking to your top customers once a month, bi-weekly or even weekly. When you have those conversations, share information. Tell them what you're seeing in the marketplace. Tell them where you think it's headed, and then ask for feedback and guidance in return. This has the additional benefit of cementing a moat around your relationship. So if the economy ever does turn south, they'll be looking to cut orders with one of your competitors because they view you as a value-added partner rather than a commodity or transactional supplier. Okay? Step number 2, cannot stress enough the importance of this. Protect your margins. The successful companies that I work with are largely approaching tariffs through surcharges. They're not doing across-the-board price increases. If they do feel compelled to increase prices, they're leaving their core, most dependable customers alone and raising prices for tier 2 and below customers. Low volume, kind of one-off orders here and there to make up some of the additional cost infrastructure from tariffs. But also ask yourself, when is the last time that as a business, I actually shopped around for all of the things that I buy? That includes your electricity contract. It includes your shipping and logistics costs. It includes all of the inputs that you have. If you haven't gone out to the marketplace and gotten a few quotes for all of these inputs in the last 6 months, now is the time. Use other people's pessimism to your advantage. Right? You're able to negotiate better rates, lock in some savings for yourself to offset some of the additional costs. And then the last part, again, very quick, competitive pay, key to retention. Make sure you're doing everything to retain your folks. Okay, this QR code is my LinkedIn profile. Please connect with me. I'm always putting out commentary and analysis, and I will help you make sense of the world. My email address is also there. And with that, I think we're done. And thank you very much, and I'll take some questions.
Hi there. I was just wondering what your thoughts are on the biggest risks for 2026 with regards to your outlook.
Yeah, so I hope you were able to tell that my presentation is based on logic and reasoning and objective perspective. We are not living in a logical world today. So I would say my biggest fear for 2026, the biggest black swan possibility, is that an individual is able to alter the trajectory for all of us because they have that much control. And that control is concentrated in China, in Russia, in North Korea, in the Middle East, and now in the United States as well. And so that's my biggest fear, is that we act in an irrational, illogical manner, and that might derail the whole outlook. Okay? Yes, sir.
Curious what your thoughts are, pending debt crisis, keeping in mind that China is becoming more reluctant to take on U.S. debt, as well as some other countries.
Yeah.
Could we be headed in a bad situation?
Really important topic. I'm glad you asked about that. So, two thoughts. First and foremost, the debt crisis is real. It's something that we have to address. And it's really amusing to me that while Republicans were not in power, the focus was on driving down debt. And now that they are in power, we seem to have forgotten about that a little bit. So, I think that the One Big Beautiful Bill Act, while very positive in the near term, long term will only add to the deficit. Right now, we're somewhere in the 100% debt to GDP ratio. The projections of current President Trump's agenda have us going to about 140% 10 years from now. So that's a real issue. I don't think it's a crisis in per se. Like some people elicit the idea of Great Depression coming around once again. No. Our costs of financing that debt will go up. That means that we have less money available to spend in other programs. But long term, I don't think that this is the calamity that's going to bring the United States down. It's just going to become, we're going to become less effective as a country because so much of our effort and resources are going to go into paying down the interest rate portion only of the debt. Okay, so the second piece is really important. A lot of people think that our foreign adversaries, China in particular, can harm us in a major way because of our debt. I don't buy into that because 80% of our debt, of the 37 trillion, is domestically held. It's held by intergovernmental agencies, so the US Treasury, the SEC, and so on. It's held by insurance companies. It's held by all of us in our retirement portfolios. Anytime you buy treasuries, that is the government debt. So 80% is domestic. It's not going to be called in. We're not going to undermine ourselves that way. Of the foreign debt, China used to be the largest holder. They used to hold about $1.5 trillion like 5 years ago. Today, that's been cut in half. They've been slowly selling it off. They don't want to undermine the dollar because their currency is tied to it. They don't want to disrupt the financial system. But they're also looking at the way that we've treated Russia in this period of time. And they're saying, we don't want to be as susceptible to the US clamping down, to cutting us off from SWIFT. They've been building up gold reserves in a major way. But the other foreign holders are our allies. It's Japan at number 1, the UK at number 2, and many of the other European countries at number 3. So I'm more concerned with the ramifications of our debt internally, meaning how productive and efficient can we be, rather than worrying about other entities, especially our adversaries, harming us through our debt vehicle. Okay? I hope that helps answer your question. It is. 37 trillion is the last. Yes. It continues to go up. We're adding about $1 trillion every 3 months, just to give you the pace of it. That's correct. Well, we do not have the ability to print fiat currency the way that the US government does. I would love to be able to do that. But, in all seriousness, and I will caveat this to say I am not a financial advisor, so please don't take this as financial advice. When the world started to shift very clearly in President Trump's second term, I took some chips off the table, personally. I'm not as risk-prone anymore. I do have some precious metals. I do have some other, physical hard assets as part of my diversified investment portfolio. And I think the probability that the market continues to tear higher from here is smaller than we have a substantial pullback. Now, long term, I still want to make sure everyone is investing because I believe in the United States' ability to overcome these challenges, and you are going to be better off in the future if you invest. But do so with a little bit of a cautious mindset right now, because not only is the world on fire, as I showed you earlier, but we're not helping our own cause through policy initiatives. Did you have a question, sir?
Yes, I have a question. Well, first of all, very good presentation, very
Thank you,
clear, and very useful.
Thank you.
My name is Gabriele Campana. I'm with Onyx. We're an off-site builder
Okay.
of residential homes. So my question is, what numbers do you see and you foresee for the future in residential construction as far as materials, also labor, being a lot of the labor is being shipped
Yeah.
out? And then also a little ingredient on AI, what is happening in the market.
Okay. I can talk for 2 hours just on those two topics. I'll try to keep it brief because I want to let you guys go to the show. So in terms of residential side, okay, we have a huge amount of pent-up demand. If you look at before 2008, 2009, the average rate of selling single-family houses was about 1.5 million units per year. We have not cracked a million still in over the 15-year recovery period, and the builders all shifted from starter homes like the 2,000 square foot kind of situation to mini McMansions and like upscale, because that's the only way that they could really make the kind of profits that they wanted to make. So the combination of increase in home value and now the interest rate environment means that so much of the market is locked out. If we see these rates come down to even the neutral territory that I was talking about, I do think that there's going to be a nice swell of people coming into the market. The question is, will there be enough supply to make sense for them to buy? I remain doubtful on that, both from a material cost perspective and from a labor availability perspective, especially with this immigration stuff and the targeting of construction zones, specifically by ICE agents. So, one comment that I'll make here before I answer your question on AI. We have had a lot of focus on stopping illegal immigration, and I'm fully behind that. I do think that we need to control who comes into this country the right way. But we have not done enough to fix the legal immigration process in this country, right? And all business owners know this. So we need to turn our attention to that, because there's a great report. Highly recommend you read this. It's only about 10 pages. It's called The Rising Storm, and it's published by a company called Lightcast. In this report, it basically says without immigration, we start to lose hundreds of thousands of people from the workforce every year in the year 2027. So it's not at some far off point in the future. It is imminent. We've got to fix illegal immigration. Besides that, the only other answer is automate, automate, automate. There's no people to fill that gap. So unfortunately, my outlook for residential housing in the near term is more stability rather than a nice leg upward. To answer your question about AI, I was at a conference yesterday in Providence, Rhode Island. Every single session had some touch point about AI. Companies are using AI, they're exploring how to use AI. It is going to be a huge game changer. So my recommendation to you from a personal level and from a business level is start dabbling. If you have not interacted with ChatGPT, Perplexity, or any of the other large language models, many of them are still free. Start to experiment to see the kind of things that you can accomplish. But the advice that I would give you is don't treat it like a Google search. It's not just about asking a question, getting an answer. It's about more complex engagement. Describe the situation that you're trying to address, what your goals are, and then ask for some recommendations, and then see how you can build from there. Last point that I'll make here, and I think this is really, really important. Don't fully convince yourself that AI is the solution. It is a tool, in my view, that it will increasingly become important, and especially the younger generations are relying on it more and more. But you don't want to put all of your eggs in the AI basket. There's too many questions that still have to be answered. And so I take a cautiously optimistic outlook to the way that businesses will use AI. Okay? So thank you guys so much for your time. Really appreciate you being here.